Oil crossed $116 a barrel on Tuesday as President Trump struck Iran's Karg Island, the hub responsible for moving 20% of the world's oil supply, and warned that a, quote, whole civilization will die tonight if Tehran doesn't reopen the Strait of Hormuz. That threat alone moved markets. But the deeper problem isn't the oil price. It's what the oil price does to the Federal Reserve. Chicago Fed President Austin Goolsbee said Tuesday that the U.S. is facing a stagflationary shock, rising prices colliding with slowing growth, and that the Fed has no obvious playbook for it. His word was uncomfortable. New York Fed President John Williams warned that elevated energy costs pass through to airfares, clothing, packaging, and food, everywhere oil touches the supply chain, and that the full effect typically takes a year to materialize. Cleveland Fed President Beth Hammack went further. She said the Fed could need to raise rates if inflation stays persistently above target. This is not a hypothetical. The New York Fed's Consumer Survey, released April 7th, showed one-year inflation expectations rising to 3%, with gas price expectations jumping 5 points to 9%, the highest since March 2022. The Atlanta Fed's GDP Now model puts first-quarter real GDP at 1% annualized. 1% growth, 3% inflation expectations, a 4.3% unemployment rate. The numbers are assembling the stagflation profile. JPMorgan CEO Jamie Dimon wrote in his shareholder letter that the war raises the risk of bad economic outcomes, and that higher oil and commodity prices could produce more tenacious inflation than markets currently price. Prediction markets on Polymarket have already repriced. The probability that the Fed makes 0 rate cuts in 2026 hit 40% following the March jobs report. If Friday's March CPI print, the first full read since the conflict began, comes in hot on the core, that probability climbs further, and the rate hike conversation moves from theoretical to active.
While the Iran war repriced the entire rate environment, one company carried an additional weight on Tuesday. Apple fell as much as 5% after Nikkei Asia reported that the company has suffered engineering setbacks in testing its foldable iPhone, and that more time is needed to solve the challenges before mass production. Bloomberg later reported the phone remains on track for a September launch, and shares partially recovered to down about 3%, but the damage exposed something investors had been sitting on. iPhones drive over half of Apple's quarterly revenue. The foldable model was widely expected to launch alongside the iPhone 18 this September, marking Apple's entry into a segment Samsung has owned since 2019. A delay into 2027 would mean Apple misses another full product cycle in foldables, while rivals iterate. The UBS analyst team added pressure separately, publishing a note targeting only 7% year-over-year App Store growth for the March quarter, with U.S. growth described as roughly flat. UBS maintained a neutral rating and a $280 price target. The combined signal, engineering delays on hardware, slowing growth in services, landed on a stock already down 7.7% year-to-date. Apple is also the second largest company in the S&P 500, which means its moves carry index weight. The stock's decline pulled the broader index lower Tuesday, amplifying the already present war-driven pressure. The rate hike risk from the first chapter is particularly acute for Apple. A higher-for-longer rate environment compresses the valuation premium Apple commands as a capital-light, high-margin franchise. At $250 per share, the stock is already trading 12.5% below its December 2025 high. If the foldable launch is confirmed delayed and Friday's CPI surprises to the upside, the valuation math gets harder.
Not every sector moved with the sell-off. While Apple fell and Nvidia slipped, Broadcom gained more than 4% on Tuesday, and the reason points to a divergence forming inside the technology space between companies exposed to consumer sentiment and those locked into multi-year infrastructure commitments. Broadcom announced 2 deals. The first is a new 5-year agreement with Google to design and supply future generations of tensor processing units, the custom AI chips Google uses in its data centers, through 2031, along with networking hardware for rack servers. The second expands a 3-way collaboration between Broadcom, Google, and Anthropic. The AI startup will access 3.5 gigawatts of TPU-based compute capacity beginning in 2027, its largest single compute commitment ever. Anthropic CFO called it a groundbreaking partnership. For context, Anthropic's annualized revenue has reportedly jumped from $9 billion at year-end 2025 to $30 billion in just 3 months, a signal that enterprise AI adoption has moved beyond experimentation. The deals reinforce a structural point. AI infrastructure spending is no longer correlated with macro sentiment in the way that consumer hardware is. Google and Anthropic are committing to multi-gigawatt capacity years in advance. That timeline is insulated from a rate hike in 2026 or a hot CPI print on Friday. Broadcom's revenue in its first fiscal quarter rose 29% year-over-year to $19.3 billion. The company's application-specific integrated circuits, custom chips that can be tuned for specific AI workloads and consume less power than general-purpose GPUs, are increasingly the preferred alternative for hyperscalers watching their energy bills climb alongside oil. The weight of evidence points toward a widening split. Companies with consumer-facing revenue and valuation premiums dependent on falling rates face compounding pressure if Friday's CPI is hot. Companies with locked-in infrastructure contracts and hyperscaler clients face a different picture. The verification point is Friday's March CPI. If headline inflation comes in above 3.5%, Cleveland Fed President Hammack's projection for April, the rate hike conversation becomes the dominant market narrative for the next month. If core comes in close to February's 2.4%, the stagflation thesis softens and the sell-off may pause. The scenario that would prove this wrong, a ceasefire announcement before 8 p.m. ET Tuesday, which would bring oil back below 100 and reset the entire rate calculus overnight.